And we're live. Hello, everybody. Thanks for joining us this week on Canadian Mortgage Hangout. I am your co-host, Rob Campbell, joined by the always impeccably dressed and polished head, Gord McCallum. Gord, how are you?
I'm pretty good. I'm pretty good, Rob. Thanks. I appreciate the
polished person, or he has a polished head.
Polished head. Not really. I'm from Saskatchewan. There's only so much you can polish somebody from Saskatchewan.
Gord, we're lucky enough to get Gord off of the online gaming for a half an hour, and he can join us today. But he's going to use that online gaming headset. But it is much clearer than before. Anyway, the 1,000 people that are already watching, I'm sure, aren't here to listen to us ramble on and poke fun at each other. They're here to listen to our guest today. So his second time on Canadian Mortgage Hangout. We had him in the fall of, I believe, 2014. Mr. Ron, the man Butler. Ron, how are you?
It's the mortgage business. What can I tell you?
Great. So you're saying you're absolutely fantastic.
You know, I think in the mortgage business today, people fall into two categories. There's like the category of everything's great, couldn't be better, positive attitude will overcome everything. And there's the category of, what's going on? It's horrible. So I think that's definitely two camps in our business.
Ron, do you think that the two camps are divided amongst people who've been at this a while and people who are just getting into it? Or we were kind of batting that around today in our office because we have a newer broker who's been with one financial institution for a number of years, and now she's getting used to becoming a broker, and she doesn't know how much easier it was before. So maybe ignorance is bliss. What's your perspective on that?
Yeah, I mean, ignorance is bliss, because we think back to the days when all you ever needed to get for a file was about 11 sheets of paper total, and you were done. But I think that the real point is that we're at a point in our business where we have some serious competitive issues, and I know that a lot of mortgage brokers like to say, the competition is all just between your ears. If you can talk to the client long enough, make up a good enough story, you have a great strategy, you've read less than 7 books, that you'll be fine. As long as you have this patter and this Zen brilliance to, I'm not Drew Justin, because I think he's one of the best mortgage brokers in Canada, but if you could just have techniques to hypnotize the client off of any subject to do with the competitiveness of our product, that you will be fine. And I guess that's probably true, but there's only so many people can be hypnotized. And at a certain point, the great fear I have is for our industry is that enough real estate agents say to each other and say to their clients, these brokers used to be very competitive, but now they're crap. And they require an enormous amount of paperwork to get deals done. Our clients will be irritated. The rates aren't that great. And really, we should be talking to the CIBC road rep in our office, who comes by our office and brings us identically the same donuts amounts as the mortgage broker does. Okay, I think that's a genuine danger. I love all these guys. I love all of our monolines. I'm a tremendous supporter of monolines. But at the end of the day, if First Nat's rate on something that needs a 30-year amortization is 289, and CIBC's 259, RBC's 259, and TD's 259, I think we have an issue, that we have an elephant in the room that deserves discussion. Because 5 beeps is fine, 10 beeps is fine. You might even survive eminently at 15 beeps. But a relentless 30 beep discrepancy on 5-year fixed is eventually going to create some chaos. And as much as other people might say, well, sell them a 2-year, sell them a variable, try this, convince them to put less down payment, and we'll turn them into, we'll start show them some math that they should pay the premium, and they'll take a high ratio deal from one of the model lines. I mean, like, holy mackerel. When you hear that stuff, you realize something slipped over the edge here. And
Right.
we got to be concerned.
Well, in fact, didn't a 20 or 30 rate, or 20 or 30 basis point rate advantage, isn't that what ultimately helped us capture a lot of market share?
I don't know if it was ever really 30, but God knows that the fact that we were always cutting edge competitive at all times.
Well, it hasn't been in a long time. I would say it's been closer to 20 in recent years. I would say, though, realistically, when I started in the business, 2002, 2003, I was up against a lot of posted rates at the banks in Edmonton, but there was almost no broker market share out here, certainly not on the A side. And the institutions I was up against didn't have to compete and didn't want to compete. So they were charging, I was 150 basis points cheaper in some cases.
Well,
that was just the reality.
I don't think we ever actually had that in Toronto ever, but you're right. You're dead right. We had a realistic rate to develop, and we had better product. We had better product at the same rate. We had better product at a slightly better rate, and that's not the way it is anymore if you need 30-year amortization. And let's face it, what realtor is going to tell their client, oh yeah, you need to buy less house so you can fit into 25-year amortization? I mean, I don't think we're going to hear that too often, right?
Right. Yeah. Rob, do you want to get into the history with Ron? I mean, maybe for our viewers who aren't as familiar with you, Ron.
I ran this by Ron, and
never climbed Mount Everest. So
Ron's under the understanding that nobody really cares. Well, I don't challenge Ron on I challenge Ron on only two things. One, that he's not as unliked as he thinks, because I remember the last show he was on, about 80% of that show was about how he felt that the mortgage brokerage industry hates his guts. But second, I feel that the story of really high producing, very successful, very much loved / much hated brokers, I like those stories. I like those stories of stories of struggle or stories of coming up. But Ron doesn't want to talk about it, so that's okay.
Well, I'm not interested in talking about history, but I will address a very good point that you just made. A very good point you just made is that what are these top 25 mortgage brokers doing differently than other brokers? And they're all doing something different. They're none of them doing identically anything the same. But I will tell you this: all the big brokers I know do something that's entirely unique to themselves. Whether it is rate discounting, whether it is advertising, whether it is a particular product mix that differentiates themselves from others, whether it's some type of marketing. All I want to say is this: whatever the top 25 mortgage brokers in this country are doing to be the top 25 individual mortgage brokers, they didn't get it out of a book. I guarantee you that. They developed it themselves. It's absolutely a outgrowth of their personality, their own ideas, and their own belief structures. Okay. Don't get me wrong. You could do a real good $45 million a year business, $25 million a year business on a book. You could read a bunch of books and you can adopt a system somebody else uses. And if you want to do $275 million worth of mortgages a year on your own, first of all, you're going to need some help, and not other agents. You're going to need some assistance. But you better be doing something that's unique, that's specialized, and that is your own thing, because that's my observation of everybody.
And to add to that, would you agree that as of November of last year, that even rings more true now than ever? I mean,
yeah, I would agree.
Before October, November, it was like, oh, we're going to roll with this. Whereas now, holy smokes, you'd better have a really hyper-focused niche, right?
I'll tell you that I know this to be true, that although bear in mind there's regionality in every business. Every business has a regional makeup. Every real estate market has a regional aspect. But I'll tell you this, what I hear from other mortgage brokers, and what I hear from the people who run the mortgage brokerage industry in terms of the super brokers and the lenders themselves, brokers are down somewhere between 5 to 20% overall. But and that could just be also, it might be closer to 20, but the all hard news that the numbers haven't hit yet. So that being said, there are some brokers that are up enormously, and some brokers who are up a bunch, and they seem to fall into those categories that you just mentioned. They're either, I know that almost all of us, well, at least in Toronto, that all the discounters are up. We're up. CanWise is up. I think True North is doing okay. I mean, True North has a big presence in Calgary. Calgary market's a little soft right now for lending, but I think they're doing fine. Discounters in Vancouver are doing well. And the specialty people, like the people who are specialized in rentals, investment properties, are fabulous. Like again, based on regionality. I mean, here in Ontario, massive. I mean, absolutely massive. So there is.
And our rental market's soft along with everything else in Edmonton right now. So there hasn't been a huge priority on that, but it may change, may shift. Yeah.
Well, at $75 a barrel, it'll probably shift for sure. But you're right. I mean, it's all regional, and
yeah.
I think that when we hear about a national decline in overall numbers, and again, this is coming not just me making it up; it's coming from lenders and from the super brokers as well. That there's definitely something to these rules that have affected us, and these rule changes have affected us, and not positively. So, the rant part of this, I'll just get it out of the way, is that I want to say just a couple of things. First of all, I think that mortgage brokers and monoline lenders have provided an enormous benefit to the average Canadian in this country, have for a long time now. That they've created great competition. As Gord, as you put it so well, when you started talking to people about mortgages in Edmonton, there were a lot of bank branches that just said, no, it's 4.75. Are you crazy? There's no discount for posted. So clearly, there's been great social good done by us as an industry and by these monoline companies providing rate competition and product competition to the big 6 banks in Canada. That's a fact. And by the way,
and advice, I'd add to that, just advice and professionalism, speed, all that stuff.
All that stuff. And that's actually a social good. Like if you're Coca-Cola and Pepsi-Cola, no matter how much people like those things, if your sales are way up, you're just actually making people fatter than me. Okay? I mean, that's reality. You're not doing any social good. But we as a group of people, as monoline lenders, let's just think about it for a second. Has everybody's utility bills gone down for the last 7 or 8 years? Apparently not. Apparently way up. Grocery bills down. Are wages way up? Like, are wages up massively for the working person in this country? No. The answer is no on all counts. But what is the one thing that's actually gone down in price for working families is their mortgage payment. And I'm not going to pat ourselves all on the back. There's a lot of economics that got to do with that. But we've certainly helped. We've helped find ways for people to have better rates, lower cost, given them advice about whether they should be in fixed or variable, short term. Overall, they've shrunk their monthly mortgage payments while everything else is going up. I think that's a great social benefit. And here's the fascinating thing. We've got Evan Siddle, the president of CMHC, telling the committee, the parliamentary committee, that we are, monolines, mortgage brokers, borrowers in general, a bunch of drunks, drunk on low interest rates, and he's here to take the punch bowl away. I'm not making that up. He said that.
Yeah. He also said, Ron, he said that the consequences of their decisions were entirely predicted and desired, that they were not unintended consequences. They were in fact planned, which is, wow, really, I'm glad you brought him up. Evan Siddall is a hot topic of discussion in the industry right now. And he really, during that interview on the parliamentary committee, made it clear that no, in fact, we're okay with less competition in the marketplace. We're okay with fewer brokers and monoline lenders. He didn't come out and say that specifically, but that's
and we're really okay with the banks controlling it. We're very okay with that.
Yeah. Okay. Yeah, we're okay with them setting the rate and everything else.
That brings up an interesting bit of history. A little bit of history. The president of CHC prior to Evan Siddall was a wonderful woman whose background was the co-op credit unions in Saskatchewan. And her steadfast belief was that one of the critical functions of CMHC was to bring competition to the big six banks, because she was from a world where she realized that there's a need for competition. She's from the credit unions in Saskatchewan.
Yeah.
So she said, yeah, we don't want to cede complete control of the mortgage business in Canada to the big six banks. And I designed policies to help that occur. Keep rate competition, keep brand competition, keep product competition. So now her term is up. She leaves and appears Evan Siddall. Now, Evan Siddall comes from a different background. He comes from the background of investment banking. Now, as we all know, there's nobody who is more the champion of the little guy than Goldman Sachs. I mean, that has got to be the consumer's friend of investment. All right? So it's crystal clear why the policies have changed. Watch what he said. Just listen to what he says. Observe his body language. And it's crystal clear that, yeah, not just he wanted this to happen, but he's got plans for more. There's more stuff coming, for sure. So I think we need as an industry to maybe rethink our strategy about how we're going to deal with this thing moving forward. Not to say that all the people who've worked very, very hard, some of them on their own dime. I mean, when you see Gary Morris flying up to Ottawa, he's not got an association paying for his plane ticket or his hotel room. He's doing it on his own. And, I think we really need to compliment all these guys who've devoted some of their time and some of their own money to going there and fighting the good fight. It's much appreciated. But
just on that note, Ron, sorry to interject there, and I'm not trying to throw any specific network under a bus, but are you, I mean, personally, I'm surprised, and I'm not shocked that Gary's the only guy as far as a network head. Are you surprised at that? Are you surprised? And I could be wrong here. There could have been others. But from what I've seen, Gary is the only person. Well, Hallie, she's from a lender. And Mike Lloyd is a broker owner of his own brokerage and network out there. But as far as like the heads of state, if you will, are you surprised that not much more of that has happened? And I could be wrong. Maybe you can correct me on that.
Well, there's been a few people up there. Stephen Smith's been up from First Nat's been up on several occasions. He's a vocal proponent of keeping his business healthy and vibrant. Sure, there's some people who won't go. Listen, we've got to understand that there's a real issue here. When you're talking about going up against your government, remember, they are the rulers. We are the ruled. So there is always an element of fear, especially in businesses that depend on OSFI rulings, the Office of Superintendent regulations, that for their very survival, that they're harming me now, but what more could they do? So do I want to piss them off? I mean, that's a real thing that exists. So you got to balance that. But here's what I have to say on that topic. What more could they do? I mean, there's probably a few more things they can do, but is the idea that we're just going to go up and keep getting selfies taken going to effectively manage that problem? I think there has to be other means employed. And again, I'm taking nothing away from the people who spent time and money and their, and lack of loss of business by not being at their jobs for doing this good work, and it should continue. But there needs to be a different strategy. It's crystal clear by looking at the way the government's responding to questions today that they don't have the tiniest thought of changing anything back to the way it was. And in fact, I think there's a great chance that risk sharing is going to go through. And that's going to be another nail in the coffin of monoline lenders, because it's much easier for a bank to deal with risk sharing than it is for a monoline.
And Ron, for us laymen, explain to the viewers what exactly risk sharing is and why that's going to impact these monolines.
Well, it comes back to the idiotic simile that is that in every insurance there's a deductible, which is like a profoundly idiotic statement. But let's just assume that in every insurance there's a deductible. So there's CMHC insurance, the borrower stops paying. This is now a claim against one of the insurers, whether it's CMHC, Genworth, or CG. Mr. Siddle's idea is that the insurer is going to pay some of that, but not all of that claim, and that the institution is going to be on the hook for a certain amount of the claim. His idea is that this will cause the lenders to have skin in the game, and it will make them better underwriters. Well, I got news for you, Mr. Evan Siddle. If the monoline lenders were any better underwriters, we'd be getting saliva tests and urine samples from the client. I mean, you literally could not do more underwriting than monolines are doing today and issue a mortgage. It's impossible. So his argument is completely facetious. What we really talking about is the lenders to have skin in the game. If you've got bad underwriting, turn down the claim. Okay, just turn the claim down. People are really thinking twice about their underwriting at that point. So he has a mechanism right now that he could use if he's that worried about skin in the game. Now here's the problem with the deductible. When you're going to say to every lender in Canada, yeah, if you've got a CMHC mortgage, if there's a claim, you're going to pay a sliver of that. We're going to pay almost all of it. You're going to pay some of it. Well, for a big bank, that doesn't mean much. They're big banks. Okay, there's always some money floating around. But if you're a monoline, you've got to set aside a certain level of reserves to pay that. And that means you've got to have another adjustment to your pricing. Because that's the way a business works. If I've got to put money aside that I know I'm going to lose on claims, I'm not just going to take it out of my bottom line. My shareholders expect a certain level of return. So at that point, you got to change your pricing again. It's that simple. Banks, not so much. Banks, hell, most of the banks in this company have been fined millions of dollars by OFSI over the course of the years for different things. So they know they've got money in the kitty to protect themselves from things someday. Don't get me wrong, the banks don't like it. They don't like it because they see it as an extra pernicious cost too. That makes no sense. Going back to my suggestion, just turn down the claims. If it's bad underwriting, turn down the claim. But
and on that note, Ron, if I'm First National, I'm not picking on First National. I'm just using them as an example. If I'm First National and I issue a 95% loan-to-value loan that's got a CMHC stamp of approval, and the client walks away from the home, and First National now has a claim, you're saying, for people that don't understand this process or maybe new to the game, when there's a loss on that property, First National now has to, or any bank or any lender has to now turn around to CMHC and go, hey, we kind of got a loss on this property. Can you? And at that point is when CMHC opens up that file and reviews everything, right? That's the current process.
The file is audited. Every claim is audited, and the claim occurs sometime around the 120th day of default, and the claim is filed, and the audit starts. They really dig into the file. Historically, underwriting is very good in this country, particularly amongst the monolines, and those claims are all paid 100%. So the essence of it is that if you've got this stamp of approval, as you say, on the mortgage from CMHC, even remember, some of these mortgages are also bulk insured. They're 80% mortgages that the monolines have that they've bulk insured with the lender. So that's another claim that can occur. Suffice it to say that once that claim is submitted, almost all of them are paid because the underwriting is solid. And what Evan Siddle is saying is, no, we're going to take a sliver off of all of them. Off of all those claims, you're going to pay yourself.
It's tax. Let's call it what it is.
It's a tax.
It's a tax with no basis in there hasn't been a change in the risk profile. There hasn't been a change in defaults. The default rates are all within acceptable realm. CMHC has enough capital to withstand major market corrections. And let's not
40% correction. Yeah,
exactly. And let's not forget, CMHC underwrites these too. There is a pre-claim underwriting.
There's a sovereign guarantee of 90% on all the other private companies. Yes, that's correct.
Right, but on all the private insurers as well as CMHC's business, let's not forget that these files get looked at by the insurer prior to approval. So CMHC is now saying,
you mean the claim files?
no, I'm saying at the time of application.
No, the insurer doesn't. There's no live read of a file with the insurer. Well,
there are occasionally. It goes to Emily, and if it doesn't pass Emily, if it's on the borderline, it's referred to an underwriter.
In terms of an approval, but they don't actually. They'll either issue an approval or they won't. But they rarely look at any documents. They don't see documents. They just ask questions, get answers, and that's how you get approval.
But they set the guidelines. They set the requirements
absolutely,
for what documents the letter should obtain over and above the OSCE guidelines, I presume.
Absolutely.
Right.
Yeah.
So they're saying we're going to hold you more responsible for a decision that we collaboratively made at approval. We're now going to hold you more. It's a tax. That's what it is.
Now, to your point, Gord, with this tremendously low default rate in Canada, how do you even justify the increase in the premiums? Like, where did that come from? Like,
because that's a tax too.
That's another tax. It's a tax on people who want to buy houses. I mean, and don't have 20%.
So I feel bad for you guys. I mean, this is one of the last bastions in Alberta of a place that doesn't have, not to get too completely off topic, but a land transfer tax. We don't have a land transfer tax. So, but really, Ontario, BC, and a lot of other parts of the country, you're getting taxed 6 ways from Sunday to acquire and dispose of property.
Correct. Well,
and
here's the thing. One of Mr. Siddle's justifications for his theories about the marketplace is that, and he made this quote in a speech in London. He said, "None of these stress tests will come up against the one that I'm interested in, which is the Great Depression." That's another one of his quotes, that the most accurate stress test would be a return of the Great Depression. Well, if that's your mindset, then I guess we're humped. Because if we're using the Great Depression as the benchmark, I guess nothing works, which is just a verification of the fact that he just pulls it out of his ass. That's the bottom line. I mean, he just says whatever he wants to say, thinks up his own opinion, and there is relatively no basis in fact. He quoted a book. He keeps talking about a book about the U.S. debt crisis in 2008. Now, there's about 156 books about the U.S. debt crisis, but the overarching truth of the U.S. debt crisis is that it was based on ridiculous mortgage underwriting. I mean ridiculous. I mean
government-sponsored ridiculous underwriting.
Government-sponsored ridiculous, but ridiculous just the same. Okay, I mean, if your underwriting is, and I've read the document itself, I've read one of the prospectuses for a mortgage tranche sale of securitized mortgage debt in the United States. So the requirement was that you'd have to have at least a 525 Beacon score. You would have a self-declared, self-signed employment letter that talks about, there's no referencing of any employment verification. That the financing is for 115% of the property value based on broker-ordered appraisals. Now, if you don't think that that will have a bad result, if you use that kind of underwriting, I don't know what you expect. So his thought that it's some kind of magical properties associated with the 2008 debt crisis in the United States, that there's some kind of similarity to Canada. Somebody's got to show him that he's wrong. There are no similarities. We have fabulous underwriting of mortgages in Canada. We have stringent rules, and we have, from all that I know about OSCE, we have great audit, that there's a very careful review of the overall guiding principles of all these lenders, whether it be a bank or a monoline. So at the end of the day, the facts that he's using are alternative facts. They're his own facts. They're his opinion, and they're not true. Look, I'm not saying there's not a property value bubble in this country. I mean, there is definitely one in Ontario today. I mean, we've got people running around buying stuff on the assumption it's going to go up 2% a month. I mean, we've got rampant speculation in the marketplace here. We've got people in our own little company. We've seen people who have bought a house in November. They've sold it now. They painted the place. They had a $130,000 lift. So if that's not speculation, I don't know what the hell is. And speculation in real estate will always have a bad result in the end. That's for sure. I'm not saying this year. I don't even know next year. But I'm not one of those people who thinks that real estate values can never go down. I think they can.
Yeah. Well, there has to be some link to affordability at some point. So yeah.
And I can speak to the GTA coming out to where I am in Guelph. Factually speaking, year over year, the month of March has seen the average price increase of 41.2% year over year.
45% in Richmond Hill, a suburb of northern suburb of Ontario, of Toronto. Yeah.
I mean, just to I'll help bring the average down to reality. Then in Edmonton, our average price has still not caught up to the peak of 2007.
So, Gord, this brings up another fantastic point. This country's real estate is regional. So why in the world is somebody in Alberta going to pay a higher price rate on renewal, thanks to Edmonton City, than they should be? It just makes no sense. It's crazy.
Well, I would agree, and I would say the correct market response to if there's an affordability issue in one part of the country, there's this wonderful thing called a highway and four wheels that can get you down it to purchase a home in another marketplace. Like if you're in Vancouver or in Toronto, you feel like you're priced out of the market. Guess what? There's all these other places you can go. And a lot of them need people because some of them have labor shortages. We don't happen to have that here in Alberta right now. But there have been times when we've had labor shortages. There have been times in Saskatchewan or Manitoba or who knows where you can go get a job and you can make a nice living and you can afford a home. And it's a great thing about a free society is we have that mobility. Now, is it hard? Sure. Is it disruptive? Sure. Is it anything at all like what the pioneers went through when they had to clear 160 acres by hand to farm it because they came on a boat from overseas? No, it's nothing like that at all. It's a whole lot easier now, and it's available to people. And so it's frustrating to see these regional things pop up and to have a government setting a national strategy and national policy on that basis when it doesn't have to be that way.
By the way, I'm the only person in Ontario who knows that 160 acres is a quarter section.
There you go.
Well, I lived in it for 4 years, so I know a little bit about that stuff.
Well, we miss you still.
Right. You're 100% right. There is no sense to a national rate increase policy when you've got no national housing market. It's literally nuts. But that's what we're up against right now. All I would tell you is that we're not going anywhere. Mortgage brokers aren't going anywhere. We're here for the duration, but I will suggest to you that it's going to get worse before it gets better. And that's not, I was looking at a Facebook post the other day that we should just change our messaging about how things are going and avoid talking about certain things.
Right.
That's not my opinion. My opinion is it's always better to tell the truth. It's always better to understand real market forces. And even though, yes, we have to continue to devise new and better ways to present our products, our rates, and our advice, but still, let's not pretend that there isn't a real marketplace that we have to exist in. And the next fight, in my opinion, is a political one, that we're going to have to change our ways. And as the next election approaches, we're going to have to think of a means to better influence the government in Ottawa to be supportive of the mortgage brokerage industry, and the monoline lenders in Canada, who, as I said before, have done a great social good for this country. That let's get the policy changed. And to change the policy, I think we may have to change some personalities.
Rob, you had a question, and I want to follow up with one or two more. Ron, if you still have time, this is a fascinating discussion for me, and I always like how you bridge the macro and the micro together because they go hand in hand. But Rob, what was your question?
No, just tying into the regionality of the market, the different markets. We're already starting to see rate sheets that that are becoming more and more complex and convoluted as the weeks go by.
So rate sheets look like the periodic table. Yes, that's correct.
Yeah. To a 3-year-old. How long now before we see rate sheets that have postal codes on it? If we move to a regionality where that might make sense, where we go, well, the anything that starts with an M as in Mary is in the GTA. We're going to scale that back, and anything that starts with it, you know what I mean? Do you think that's too far-fetched, or do you think that's coming soon?
We have regionality in lending right now. I mean, Gordon will tell you we have regionality in lending right now. There is a lot of discrimination against some Alberta areas, some Alberta properties, and some Alberta loan-to-values. That's reality. That's a fact. So we've got regionality now. We're going to get some more. Here's another scary one. We now have more beacon score segmentation than we've ever had before. There's a different rate for people who have a 720 beacon score amongst monolines. That's a fact. So how much more can we do to segment this thing? How much more granular can we get until the public says, you know what? You guys are crazy. I'm just going to go to my bank, because they don't have any of this stuff. Because you know what? By and large, they don't.
And I suppose if it was consistent, that would help. I know in the insurance space, like they're getting more underwriting. I suspect as technology evolves and the data available evolves, I would suspect underwriting will get more and more granular. I mean, everything from, well, we've seen it with floodplains out here. Lenders will decline a file if it's in a floodplain. Insurance, a lot of people don't know that their insurance company, if you're getting home and auto insurance, they're credit scoring you. It's a soft hit, but they're credit scoring you. And you know why? Because they have been able to successfully correlate credit score to probability of a loss or a missed payment. So that kind of stuff is happening, and I think it's going to continue to happen. One thing that I'm worried about, Ron, and there's been lots of talk in Canada about a productivity gap. That's one of the problems we have in our country is our productivity, and that the ability to generate income per person and efficiently and everything else. And then yesterday the federal government came out with their innovation budget, which all of that and all of these recent rule changes seem counterproductive or counter. It takes more time to do everything. It's more work for the consumer. Let's not forget there's a cost to making the consumer jump through all these hoops, which is time off work, less productive time at work because they're busy trying to find their NOAs to send to their mortgage broker. The more work we put through the client through, the less productive they are in their businesses and their jobs, not to mention our businesses and our jobs and our lenders' businesses and their jobs.
We are enormously less productive. Like, technology has helped us, don't get me wrong.
Right.
But with the down payment looks like nobody knows what a phone book anymore who's under the age of 30. So let's just put it this way. Down payment now 15 centimeters deep. I mean, it's astronomical amount of research you have to do. I'm with you. It's not productive. Hopefully there'll be more technology that'll come along that'll allow us to extract data, such as there's more availability in the US, such as to extract data directly from a payroll company, directly from your bank in a more convenient digital way. Hopefully that'll come along. But here's the real issue. A lot of these things don't happen at the bank. Like, here's what we got to realize. We've got our lenders asking us to back up every $2,500, every deposit in excess of $2,500 or more on down payment. We've got to provide some sort of source to where that deposit came from if it's not payroll. They don't have that at the bank. At the bank, the compliance department signed off on it when it hit the account. So it's over. Nobody has to prove anything at a bank. I mean, I'm guaranteeing you this. There are bank reps today, branch personnel today, who have a relentless mantra of telling their clients who are shopping for a mortgage or just bought a house, don't go with the broker. The brokers are crazy. They're going to ask you for a mountain of documents that we don't need. Because guess what? If I was in the bank training department, that's what I'd be telling them to say. It's a business. We're in competition with them. So of course they're going to say those things. Again, I want people in the mortgage industry to be cautious. When we keep telling the consumer that, oh, you really need a mortgage broker more than ever because it's so complicated. We got to realize that maybe it's just so complicated for us. It's not complicated for competitors. We continue in the marketplace, and we've got to be wary of competition on all sides. I say that truthfully. Again, the real purpose that we have to join in the coming months and years is we have got to become more politically able to influence policies in Ottawa that, quite frankly, went our way for a decade. The policies in Ottawa to do with lending and mortgages, CMHC, all the rest of it, they went our way for a prior decade. Now they've taken a turn. So we need to figure out better ways to manage that problem. That's something we're going to have to look at very closely as associations and as individuals, as business people. We've got to think about how important it is to us.
Well, excellent perspective, and looking forward to, I guess, having that debate about what those new approaches need to be going forward. Because I think we're going to have to bring a lot of ideas to the table to see what people are willing to get behind and what sticks. And it's good to have Ron. I think, back to the opening, when people talk about liked or not liked and things like that. I mean, respected is really important, and you're a respected voice in the industry, a contrarian at times, but I value that for sure. And I think groupthink is sometimes what got us here. When maybe we thought everything was going just fine, everybody was busy in their business, and now we've had this wake up moment, this awakening where we've had to now, for the first time, really step up our lobbying efforts, to have our association do what it's doing, to have the provincial associations participating, to have broker owners speaking on panels. How much further ahead would we have been had we been proactively doing that 5 or 10 years ago? Now
you're a great guy to answer that, because you know how well the P&C industry has done in terms of keeping banks out of the P&C business. And that was not a fluke. Let's face it, that was not a fluke. They work at it, they've worked at it in the past, they're working at it today, and it's a ball they never take their eyes off, and it's had great results. So you of all people know there is a political solution to big banks taking over your business. Big banks do 87% of all the financial transactions for Canadians right now. Why do they need to do all of the mortgage ones? It doesn't make any sense. And it didn't make any sense to the previous CMHC president. And what happened? Was she just crazy? And this guy was really smart, Mr. Siddle? I don't think so. I think it's a change of opinion, but I don't think it helps the average working Canadian that he thinks rates should be higher because he wants them to be.
Well, and that's a great point, and I think you've made this point online too, which is if we position ourselves as the defender of the average Canadian, the working class citizen, the middle class, the people who are buying homes, you have first time buyers right through second or third timers, even small property investors. These are people that we can ally ourselves with as brokers and take common cause with and support and encourage and fight for, both in our day-to-day interactions with lenders and at the policy level. Then that's a better message probably than saying you need us because for some made up reason that we're trying to use as a competitive wedge.
You need us because we want to keep our jobs. Yeah, that's not a reason. Right. When we communicate that message, we have a chance of success, because let's face it, another industry won that battle. The P&C industry won that battle. So it's not an impossible battle. It just isn't. So we have to take it.
Okay. Good stuff. Rob, you wanted to go to speed round?
I think we're going to wrap up. We got to be, I've got no deals on the go, so I could talk all day, but I'm sure Ron's got a couple of emails he's got to get back to. So we'll do some speed round stuff to wrap it up. Just some off the cuff questions and simple yeses or nos or whatnot. But I'll lead. Ron, when I go to a brokerage event at Broker Financial, little plug, Jason Singh, and there's a new agent and they go, oh, I just got my license and I'm new in the business. I almost want to coddle them and rub them on the head and kiss them on the forehead and say, I don't know that it's going to be okay. What's your advice for a newbie that's either just got licensed or thinking about getting in this industry, and sum that up in 1 or 2 sentences?
Quit and learn how to code.
All right, fair enough. Gord?
Ron, will there ever be a Rocket Mortgage equivalent in Canada under the current rule structure?
Well, it's not so much about their mortgage rule structure. It's more to do with how easy it is to access payroll and access banking information. There will be something that looks like Rocket eventually. I pointed out the other day, Rocket's a division of Quicken Mortgage, and the rest of Quicken Mortgage does enormously more business than Rocket. I'm not suggesting that Rocket's a bad idea. Rocket is a great idea, but still, in this country, the median age is still in their 40s. So they are not all digital. They're growing. The future is there, but the current mortgage landscape is not all digital.
Fair enough.
Ron,
thank you.
Ron, I already know the answer to this, but there's a lot of people out there that think you are Lucifer because you buy down rates and you're an online guy over the phone, all that good shit. So I'm going to set you up with the question and the answer here. Will there always be a need for a boutique, belly-to-belly, eyeball-to-eyeball broker? Yes or no?
Absolutely. There will always be a need for a mortgage broker who is just doing business one customer. There's absolutely no question. There's absolutely no question that will continue. Now, will it continue in the way that it has today? Will there be as many people doing it? Will they be doing it the same way? That's unlikely, because the truth is, and I'm not a guy, I sort of agree with Rob McClister that there'll be a lot less mortgage brokers in 5 years, but I would say this, that some people are going to learn how to work for less money successfully. And ultimately, disintermediation, which is the term you apply to when everybody knows what the rates are, just like when everybody knows where what the insurance costs, what insurance rates are, that disintermediation drives down gross margin. I mean, that's just the truth. And so, will mortgage brokers ever go away? No. Guess what? Radio, think about this. AM radio was the biggest media entity in the 1920s. Nothing was bigger. It was dominant. Now, radio hasn't disappeared. It still exists. It's just different. It's just of a different scope. So industries don't just typically vanish. They change. That's what happens.
Okay. I've got one more quick one, and then we can wrap up unless Rob has any others. Ron, what's your position, and what's your if you were looking at your crystal ball, what do you forecast in terms of diversification? Is that a strategy brokers should be going after, or not? Should you believe more in a focused approach versus a diversified financial services approach, and where do you see the industry going in that direction?
It's a good question. The reality is that both answers are true. That highly focused works, but because of the diminishing gross margins, you're going to need to have a great partner who's doing things like quality life insurance, not creditor insurance, but quality life insurance products, and making P&C offerings. It's the two things that I'm focusing on more. A lot of things I'm focusing on this year, but those two ideas of a quality, consistent P&C insurance offering to our clients and a quality life insurance offering, not through us, through the actual people who know what they're doing, but on a very organized, very systematic basis with great quality and low cost. Lowest cost you can imagine is manageable. But hey, Gary Moore, is the premier marketer in this country in our realm. You can't take it away from the guy. Here's the truth. Is there anything he's actually set his mind on that he hasn't done? Think about that for a second. He's been after Marlborough Sterling. He was after Marlborough Sterling for 7 years. I could tell you there was a point that I was told this by the president of Marlborough Sterling, that one day Gary Morris showed up in the lobby of Marlborough Sterling 7 years ago in London, England, saying, "I'm Gary Morris, and I need to talk to you about buying this company." 7 years ago. So when Gary puts his mind on something, he's always done it. Got to take your hat off to a guy who always does what he says he's going to do. Now, Gary's big rollout today is P&C insurance, because he knows that it is a real, legitimate, profitable, sensible. It's not without its competition. It's got a lot of competition.
No,
Tons of competition.
Even more so than the mortgage business.
Tons of competition. But it has one thing the mortgage business doesn't have: level commissions. So
recurring comp.
Comp, and a pretty loyal client base once they've been around for a while. So I would suggest to you that if Gary's all in on P&C insurance, that's a great thing for every mortgage broker or every mortgage brokerage owner to give some thought to.
Well,
there you have it.
There you go. A lot to consume. We went way over time. We're sorry, Ron. Good discussion. Always a pleasure to speak with you. I know I try to avoid you at all costs when I see you in face-to-face at these events. I run the other way, as most people do, but I'm kind of bound to try to do this with you today. I know you begged us, but so I guess we came through. Anyway, thanks so much for coming on, Ron. Always a pleasure.
Thanks, guys.
Much respect to you, Gord. Good to see you. We'll be on in another 2 weeks. We're going to hunt down another guest. We got some good names in the coffers, but until then, we end this show by saying goodbye.
Goodbye.
Thanks, Ron.
Thanks, guys.